SmallCapSteve Live. I'm SmallCapSteve. We're really excited today. We got Rick Rule on, who recently made a bit of a position change. Going to chat with him about that, sort of where he sees banking and mining and just the overall macro environment heading as we enter this really interesting time with monetary policy and COVID. I'm going to be joined with my trusty sidekick, Jay. It's Friday, March 5th. If you're watching us on YouTube, please hit the like and subscribe button. All right, buckle up. Let's get started. Rick, thanks so much for joining us today.
Pleasure, Steve. Thank you for having me on.
Well, so let's start at the top here. You recently had some news there at Sprott. What's going on? What's the game plan for Rick Rule?
Well, I announced that effective March 15th, I'm resigning all of the positions at Sprott that have to do with corporate management and administration of the U.S. business. And I'm resigning any position that I might have that is FINRA regulated, which is to say the Series 7 stockbroker's license. I will continue as the largest shareholder of Sprott. I'll continue, I believe, as the largest private client of Sprott. I'll continue on their board of directors. I will continue to manage money for Sprott. I will continue to mentor money managers for Sprott. And I will continue to mentor wealth advisors on both sides of the border. That's a long way of saying, at age 68, I feel I'm entitled to quit doing things I don't like to do and focus on things that I do like to do, a plan that I think has a lot to recommend it.
Okay, so what is it that you do like to do? I take it you want to sort of manage your own money. Do you plan on doing your own on-the-ground due diligence? How do you see that working?
I've always enjoyed doing my own on-the-ground due diligence, but the truth is I'll rely on Sprott for a fair bit of that. We've got a spectacular cadre of engineers and geologists. We've also got some very good financial analysts, but I'm a pretty good financial analyst myself. I will certainly originate transactions that are geared more towards myself rather than figuring out what other people want to do or should want to do. And I will allow people to invest alongside me if that sort of thing amuses them. What amuses me is two things. One, securities analysis, the whole process of determining investments and speculations that are timely, out of favor, and profitable. The other thing that amuses me is doing this, using my time and talent to educate people who haven't yet spent the 50 years involved in the game that I have spent. So I'll do a lot more mentoring of investors, young and old, in natural resources, something that I enjoy doing and something that literally thousands of people have told me that they find valuable.
It seems like you're one of the guys who got it really early, and we're now starting to see everybody in the media talking about how important social media is when it comes to, companies getting their stories out, and there's more and more platforms. Like we were never planning on doing video, but YouTube just exploded, and the next thing we know, we've hired a production team and we're getting yelled at about lighting and microphones and all that sort of stuff. Why is it, do you think, that everybody is so slow to understand that? And then secondly, maybe this is really the question, is how important do you think social media is today for companies to tell their stories?
I can't comment on the second because I'd prefer that issuers did their own work in IR. I can tell you two things from our point of view. The first is that the money that Sprott has invested in formal media advertising, let's just say the returns on capital employed have been mixed at best. The money and time and treasure that we have spent on investor education and investor outreach, and social media is a wonderful way to do that, has been returned to us in spades. The concept of a form of advertising where you give something to the customer before you ask the customer to give you anything else, in our case, education and paradigm, has proven to be of enormous benefit to Sprott. It has built up tremendous goodwill over in excess of 200,000 customers that we have relationships with around the world. And I would suggest that our social media output, going all the way back to Eric Sprott's doing this in 2008, 2009, 2010, is in some substantial measure responsible for the success that we've enjoyed since then. So we intend to continue it. I also believe that the whole nature of investing is changed in the sense that access to information and access to paradigm is democratized by social media. In the first instance, you literally need to know less because most of the knowledge that's possessed by humankind can be accessed at Google or places like that. So it's less important to know than to know how to know. But two, paradigm used to be distributed top down. You would get it from big media outlets. You would get it from the government. You would get it from academia. You would get it from investment banks. But increasingly now, information dissemination, paradigm dissemination is peer-to-peer, or at least very, very distributed. The truth is that you guys, SmallCapSteve, can never compete with BNN. It's equally true that BNN can never compete with you. And the fact that there are 20,000 channels or 30,000 channels, and beyond that, there are hundreds of millions of people online doing peer-to-peer distribution and dissemination, means that we have a market in information, not a top-down circumstance, but really a true market in information. And while markets are messy, markets are always preferable to any other form of distribution and aggregation.
That's so true, and it's something I often think about when I think of generations before me, and the big TV personalities. Were they considered great because they had the platform, or were they put on the platform because they were great? And it's like now we're kind of talking about a more efficient market when it comes to exchange of information.
I think we're 5 years out before social media winnows out the morons and focuses on the people who deliver value to their audience. But that whole process is useful. The nature of markets is that some people are better at certain functions than others, and ultimately they should win.
Mm-hmm. So let's talk about some precious metal stuff. In terms of social media context and precious metals, we've seen some attempts here at squeezing the shorts on silver. Gold seems to have just terrible sentiment right now. In our world, we talk to a lot of millennials. They think that the inflation hedge is Bitcoin. What's your take on how important sentiment is here with gold and where it's sitting overall?
Sentiment in the near term is all important, and in the long term isn't important at all. In the long term, facts matter. Money is made, I think, in the delta between current popular opinion and arithmetic. So let's unpack your question. Bitcoin and gold. Bitcoin and gold are, from my point of view, very separate and compatible asset classes. In the very near term, Bitcoin and gold compete on the margins. They compete in the fringe. They compete for speculators who think that silver is going to $150 an ounce, and people who think that although the Bitcoin audience hasn't grown dramatically, that Bitcoin is more valuable at $50,000 than it was at $10,000. These are all suppositions that are interesting and, of course, wrong. The utility, and by the way, I'm very, very, very pro-crypto at Sprott and individually. We have invested millions of dollars in blockchain and distributed technology, primarily around the ownership, authentication, and distribution of gold and silver. But I really believe that distributed ledger technology will change the way we live and think, both in financial terms, but also in political terms and other terms. Bitcoin itself is, of course, a small subsector within the distributed ledger. Bitcoin's primary utility has been the potential for almost frictionless exchange. which is to say very little fees, very low commissions. Also anonymity, structured correctly. As an example, if you happen to be in Nigeria, you were Nigerian, and you wanted to get Naira out of a blocked country, or pesos in Venezuela, you could do so with Bitcoin. And the fact that as a peer-to-peer network, you didn't have to trust anybody. You weren't at the behest of the Canadian government or the Royal Bank of Canada or any of those people. That in fact trust and authentication happened as a consequence of the network and was peer-to-peer. All that's good. One problem I see with Bitcoin is that as a medium of exchange, the very volatility that makes it popular as speculator diminishes its utility as a medium of exchange. Unless you live your life denominated in Bitcoin, which most people don't, that very volatility means that if you use Bitcoin to go to Safeway to buy yourself a few bags of groceries, if you pay in Bitcoin, you don't actually know what you paid. And Safeway doesn't know what they received because of the volatility. So the very volatility that attracts speculators diminishes its utility. It's true in terms of Bitcoin and gold, too, that they are both infinitesimal asset classes. The market capitalization of Bitcoin on a global basis is about $1 trillion. And the estimated market capitalization of savings and investment products worldwide is about $450 trillion. So Bitcoin's relevance on a global scale is the equivalent of a pimple on an elephant's behind. It doesn't matter. The real competition, I think, that gold has increasingly as a store of value, and I don't agree with this proposition, but I think the real competition that gold has as a store of value are public equities. I think that many Americans, as an example, think that they can protect the purchasing power of their savings by owning an S&P 500 ETF. So I don't think that Bitcoin is particularly a competition for gold, or vice versa, except on the speculative fringes. Moving back to the first part of your question, the gold narrative, I think, fairly frequently gets misstated. My own experience in 45 or 50 years in gold markets is that precious metals do well primarily when people are concerned about the purchasing power of savings instruments denominated in fiat currencies. And around the world, the world's dominant reserve currency is the US dollar. Sometimes Canadians have their feelings hurt by that realization, but it's true. And as people become concerned about the debasement of purchasing power of the US dollar relative to the return that they get on their savings, they look increasingly to gold. So let's look at why people might be concerned about the US dollar. In the first instance, quantitative easing, which is to say the conjuring up of specious currency units from nothing. We used to call it printing, but they don't have to print anymore. They can do it with a keystroke. The debasement of the currency, which is to say the creation of excess false currency units, if SmallCapSteve did it, if he began to print up Steves, would be called counterfeiting, and you would be put in prison. If, however, you are a member of parliament, it's extremely popular and it gets you reelected, so it will certainly continue. But it does constitute the debasement of the currency. The second is debt and deficits. I don't know the applicable Canadian numbers, although I'm told they're even more obscene than the US numbers. But at the federal level in the United States, we have $28 trillion in on-balance sheet liabilities, maybe $21 trillion net of the Fed's balance sheet, and $140 trillion in net present value of off-balance sheet liabilities, entitlements, which means that we owe each other approximately $160 trillion. This is clearly unserviceable, given the national income with which we propose to service this debt is $3 trillion a year upside down, which is to say, rather than servicing it, we increase it by $3 to $4 trillion a year. The most important determinant of the gold price in the near term, however, is real and nominal interest rates. My belief for 45 years is that the benchmark credit instrument in the world is the US 10-year Treasury. I know that sounds America-centric, but America issues the world's reserve currency. The value proposition of the US 10-year Treasury is very illustrative as to the price of gold. Right now, the US government proposes to pay you about 1.45%, 145 basis points on the 10-year T, in a currency that the Congressional Budget Office, not some cranky old libertarian, but the Congressional Budget Office, suggests is deteriorating in purchasing power by 1.6% a year. This may be the first time in my life that the US government has made a promise that they're going to keep. They absolutely solemnly swear to me that if I give them money now, they'll give me back much less money in 10 years. My friend Jim Grant calls that return-free risk. If you look deeper, what you will see is that the gold price did very, very, very well as the yield on the US 10-year Treasury fell from 200 basis points to 60 basis points over the course of last year. Now that the interest rate on the US 10-year Treasury has recovered, it's still in negative real territory, but since it's recovered from 60 basis points to 145 basis points, the gold price first plateaued and then went down. The best indicator, I believe, in terms of the direction of the gold price, near term and long term, is nominal and real interest rates, particularly those denominated in US dollars. Sorry for that long-winded answer, but you asked me 3 hard questions. One brief outburst.
By the way, my hope with that was to just sort of rant about 3 different things and then figure out what you felt like talking about. And then you unpacked the whole thing and gave a brilliant answer.
That's the first time it's actually happened. And I'll give kudos to you for remembering it all, because that was great.
My challenge is I got excited by the question. I forgot to breathe.
Okay, so let's talk about the 10-year, because I'm still struggling with this. Last weekend, I kid you not, I was tossing and turning in bed on Friday night. It's now a week later. Following Saturday, I'm trying to think of, okay, who in my network can I call that understands this stuff? So I called my buddy Dan, who used to work for the Bank of Canada, who usually can explain this stuff to me. And I said, why is everybody freaking out about the 10-year going up? Shouldn't that mean that if money's being pulled out of the 10-year, that it should be going into other things? But here we're seeing equities just get totally slaughtered. What's your response to that question?
2 responses, and they're contradictory. The first is that a negative real interest rate is not a force of nature. It's a construct, an artificial construct of man. Interest on a debt instrument, if you're a saver, is the compensation that you receive for forestalling consumption. You're spending the money 10 years from now rather than spending it now, and you're letting somebody else spend it now, and you need to be compensated for that. Interest, too, is a risk mitigator in the sense that getting a current yield protects you in terms of the time value of money, and it also protects you against the credit quality of the issuer. The idea that you would pay somebody else to store your money and take a risk on the time value of money and their credit quality is stupid. Why on earth would you pay somebody to use your money who may or may not give it back? So that's the first thing that we have to understand. That notwithstanding, there are many, many, many moments of stupidity throughout world history. What you're seeing right now was as smart as beginning World War I or beginning World War II, maybe less catastrophic. But it's the same sort of mass intellectual mistake that we've seen time to time promulgated by governments in history. The increase in interest rates and its impact in the near term in the economy is very different. Very low interest rates do 2 wonderful things for stocks. First of all, they lower the cost of capital, which is to say, if you're a capital-intensive business, say in your country, Brookfield, and your cost of capital in debt, which is to say the prime interest rate tied to the US 10-year Treasury, falls by 150 basis points, and you're a multi-billion-dollar borrower, most of that savings goes right straight to the bottom line. It gooses your earnings. Money is made on the delta between cost of capital and return on capital employed. Low cost of capital is, of course, for people that have access to credit, a wonderful thing. At the same time, the very low yield on savings products increases the appeal of dividends. So the capitalized value of earnings and distributions goes up during periods of low interest rate. When the interest rate rises from the point of view of public companies, 2 bad things happen. Their cost of capital goes down, which means that the spread between the cost of capital and the return of capital employed goes down, at the same time that the capitalized value of those earnings goes down. That, as quickly as I can, explains the situation from, if you will, 10,000 meters.
Okay, so trying to think about this in simple terms. So I'm going to let Jay explain this. The 10-year goes down, or the price of 10-year goes down, the yield goes up. What does that mean, Jay?
Sorry, I'm processing things here too.
I'm trying to process.
I'm so used to small caps that we aren't used to the macro impacting things just with the environment we've been in the last few years, right? So the rising rates are really causing problems for us. So we're trying to understand the best we can, but it's concepts that have previously been unapplicable to us, right? So I'm lost in thought, and I apologize, Steve. I totally missed your question.
So it sounds like effectively what you're saying is it's just the basic relationship between the value of capital when interest rates go up, the value of capital then goes down.
Wrong. The value of capital goes up. The yield of capital goes up. Equity prices get hurt. The cost of capital for companies goes up, which means their profits go down commensurately. And the way those profits are valued in the market goes down too, because you have increased yields on savings products and less need for savers to be in dividends. Okay. Another way that you can think about interest rates in a democracy, that is a place where people vote to control other people through the democratic rather than market processes. In fact, the hallmark of a democracy is, I think, a war by spenders who are numerous on savers who are scarce. Artificially low interest rate favors borrowers, people with access to credit, to be sure, but artificially low interest rates punish savers in favor of spenders. One thing that you see in society is that spenders are very numerous and savers are substantially less numerous. Given that both vote, it's easy to see the outcome of that. There's a wonderful libertarian pin that goes, an election is the process by which 4 coyotes and a lamb decide the lunch menu. The lamb, of course, being the saver.
But so if interest rates go up, though, wouldn't that mean that just the general availability of credit goes down, which would then drive capital asset prices down? Or am I confusing?
No, you're correct there. The utility of credit goes down too. The cost of credit goes up. The availability of credit may go down. So you are absolutely right in that regard. The value of the capital lent, of course, goes up because the yield on it increases. But from the point of view of a capital consumer, what you say is absolutely correct.
Okay. So let's talk about the yield curve. So if we have an upward sloping yield curve, that should be bullish, right?
Well, bullish for who?
I think it'd be bullish for equities because it would mean that we're thinking inflation's going to go up, which means that theoretically we're expecting velocity to go up, which is bullish for the economy, should be bullish for stocks.
But the cost of borrow is higher then.
Right. Right. I think that maybe we're putting the cart before the horse in the sense that it's arguable. And by the way, this isn't really what I do. I'm not an economist. I'm a credit analyst, which is a fancy word for a loan shark. I think the circumstance that we see in front of us today is that central bankers and political figures are confident enough in the near term of economic performance, probably as a consequence of excess liquidity in the economy, that they can afford to let the interest rate rise so that if later they need additional stimulus, they can bring the interest rate down again. I think the positive curve that you see in interest rates is both the expectation of inflation. I'm not so sure it's expectation of a strong economy, but certainly the expectation of inflation. But it's also the fact that on both sides of the 49th parallel, the central bankers believe that they have room in the economy to let the interest rate rise, and they are doing so because that gives them some additional bullets to fire if they need to do it. I don't think that you would see a steep forward curve if the central bankers in both countries didn't believe that right now they could get away with it. They bring the curve down by selling very, very short-dated instruments and using the proceeds to buy long-dated instruments, which brings down the forward yields. And right now, it would appear that they're letting forward yields increase. The real thing to consider, Steve, and I don't want to really scare your audience, But the real thing to consider would be, ironically, if we had a replay of the Clinton, or in your country, Chrétien administration, where the government lost control of the interest rates, which is to say, where the interest rates were set by living, breathing human beings. If either country gave a treasury auction and nobody showed,
Okay, so
and they had to rely solely on printing, and the market took control of interest rates, I suspect that you'd see interest rates 300 or 350 basis points higher than they are now. And that would wreak, for a while, real havoc. It would be, from my point of view, very interesting to watch, hopefully at a distance on a broad screen TV. While it would amuse me, I think it would terrify most folks.
yeah, well, you've now given us something to research, because it's really interesting. We had a staff meeting last night, and we're still trying to understand this whole treasury. Typically we're small cap investors. We look at balance sheets, cash flow statements, income statements. We pour through accounting notes, but to actually understand the stuff, which seems to be so critical right now in terms of just the overall direction of the market right now, it doesn't really matter what you think is going to happen with equities. Where the overall market heads over the next 6 months seems like it's going to ultimately tell the tale. So we're trying to put all this information together, and the part that I think that I still can't wrap my head around is, can't the Fed just do whatever they want with the yield curve and just print money and just tie it effectively peg it where they want to?
I think in the near term, I think we have lived through 40 years of benign economic climate. And I believe that people my age and yours mostly believe that the big thinkers of the world, those sort of noted financial specialists like Trudeau, or Biden, have their back and control the economy. History has shown that over time, that's a very bad way to think. I'll leave it there. You mentioned that much of what you do is very virtuous. You pay attention to income statements and balance sheets. The truth is that if the United States of America were a small cap and printed the financial statements that it prints in a way that was regulated by the Securities and Exchange Commission, Congress would be in prison. It's fraud. I'll just say that simply. It's fraud. There is a truism that I was taught as a very young man. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. So you need to understand that given the disciplines you employ, which you should continue to employ, the economic circumstance that we find ourselves in the near term doesn't make sense to people like you because you're rational. It doesn't make sense. And you need to guard yourself against the fact that you're living in a nonsensical environment. Can it go on? Of course. It can go on as long as the paradigm continues. It can go on until faith is fundamentally challenged. I don't know if you like to read, but Nassim Taleb's excellent book, Anti-Fragile, talks a lot about the difference between paradigm and arithmetic, and I would urge all your listeners to read it.
Mm-hmm. It's so interesting what you just said, and it's something that I actually put a lot of thought into. Is when I have conversations with friends who they don't follow macroeconomics, they don't really even know what the Fed or the Bank of Canada is, and then they have all these political ideas, and the government ought to be doing this. Who cares if we go into a little bit of deficit to do this or that? It seems like most people don't actually understand what the impacts of all this sort of monetary easing creates, and it's such an important part of the conversation. You rarely hear brought up, except for if I'm going through YouTube and watching clips of Rick Rule or Peter Schiff or people who seemingly get it. Do you think that narrative is going to start to become more mainstream, or do you think that that's going to take us to see some sort of like monetary event or inflationary event for people to start to actually consider these things?
I think it'll take a shock. I think that shock is coming. Often in our explanations, we make things too complicated. One thing that you need to do is ask your young friends how much arithmetic that they remember. And if they say that they're okay at arithmetic, it doesn't need to be quantum physics, but rather arithmetic. Ask them if it's possible to add a column of negative numbers and come up with a positive sum.
Mm-hmm.
The federal budget, the provincial budgets, are a function of adding columns of negative numbers and coming up with a positive sum. If you borrow money, ultimately you have to pay it back. Ex-President Obama in our country said something very foolish, as presidents are wont to do. He said the debt doesn't matter because we owe it to each other. Well, that's not true. The spenders owe it to the savers. And if the savers decide not to lend, then we go to 100% counterfeit system, where expenditures at the government level can only come through the creation of new currency units. We've seen this happen in various parts of the world. This has been tried before. And those places have names: Zimbabwe, Venezuela, Argentina. The outcomes are crystal clear if you pay attention, and they aren't very attractive. It amuses me in an ironic sense that voters your age seem to be the most attracted to deficit spending and government programs. Amusing, I say, because the programs were designed to benefit the people who created them, which is to say people my age.
Mm-hmm.
We voted ourselves all kinds of cool stuff: unaffordable pensions, gold-plated health care, wonderful, frictionless, costless education. We voted ourselves all kinds of cool stuff, but we forgot to pay for it. So we're leaving you all ill. I mean, that's really what's happening. This, in the United States, $160 trillion net present value liability is really a transfer of wealth from you, from your future, to me. Now, from my viewpoint, I guess this isn't all bad. And the fact that you are really, really, really eager to give me more and pay for it strikes me as simultaneously amusing and illogical.
Mm-hmm. But it's kind of done through the veil of this complicated, like I've been reading about this stuff for 2 weeks, and you gave that one answer on the impact of capital and the 10-year, and my wheels are spinning, and same with Jay, and we're kind of like,
that's because you're a smart young man. You are expecting these things to make sense, and they're nonsensical.
So one thing you've mentioned indirectly and directly a few times now is faith, as in faith in the currency and the reserve dollar. What do you see specifically as breaking that faith? What will cause the savers to start going, I'm not lending money anymore?
I have no earthly idea. We have lived through an extraordinarily benign period in the period 1982 to 2021. We've lived in a period where the reference interest rate, which is to say the 10-year Treasury, has gone from 15.6 to 1.4, actually all the way down to 0.6. This is the kindest set of economic circumstance that's probably ever happened in the history of mankind. It's difficult, however, to take the interest rate much lower than zero. Even savers who have lived through as benign a period as they have in the last 40 years will begin to take umbrage at the idea that they should pay somebody else to spend their money for them. When will this realization take hold among savers? I don't actually know. The whole idea that we have in terms of faith in government has been an absolute mystery to me. As a very young man, I emigrated to Canada. You may or may not know that. I was 18 years of age. And one of the reasons that I emigrated to Canada personally, in addition to the fact that I thought Vancouver was a beautiful place, I wanted to study natural resource finance, and University of British Columbia was a good place to do that. But another reason was, in 1980, a young American man was going to travel. And in considering my travel plans, the option that my government had in mind for me was Vietnam. And that wasn't a very appealing option, although I understand it's a pretty place. I didn't want to shoot at people and I didn't want to be shot. So the value proposition that my government offered up to me was that the harder I worked, the more of my money they would steal. And before they allowed me to go to work for them, they were going to send me to Vietnam to fight people I had no quarrel with and perhaps be killed by them. So for me, the questioning the value proposition offered up by government happened very early. But the fact that people have continued to believe it to be an attractive option, either morally or practically, has always been a challenge for me. When you ask me questions, I guess, concerning the impact of a narrative which I believe to be untrue on the population, I'm probably the wrong one to answer it anyway. I now have a TV for the first time in 35 years, but I must admit I don't know how to turn it on. And the question that you ask is as much of a mystery to me as it is to you. I don't understand why the narrative associated with the Commonwealth, wonderful contradiction in terms, is as popular as it is among people who have learned to simply add, subtract, or multiply and divide in school. The conjunction, the collision, if you will, between the narrative and the arithmetic is very stark. And in my life, arithmetic always wins.
Okay, now I'm not sure if you have a hard stop here. I got a couple more questions for you.
No, it's fine. It's fine.
Okay. So Jay and I, when all this COVID stuff started, the first thing, our first thought was, okay, now's the time for gold. Let's load up on gold juniors. Here we go. So we kind of got caught up. We're micro cap, small cap guys. We're romantics. We're dreamers.
Sure.
we went after the ones that had the tiny the tiny market caps that were going to explore stuff. And in one case, we got caught up in one that, they were in the Philippines. They had these big swarming veins, and we looked at it and we're like, okay, there's no way that they can't hit a few drill holes. They're just going to be massive. And then the results came back, and they raised like $3 million, and they could only do 10 holes in the Philippines for some reason. And then the results come back, and it's 10 total dusters. Tell us where we went wrong.
Well, this is a 45-minute discussion, but I'll take it from the top. First of all, one misnomer that people have when they're operating on Canadian speculative exchanges, or for that matter, global junior mining exchanges. Let me put it differently. If you merged every junior miner in the world, there's probably, 1,800 of them, into one public company, Junior Explore Co. Okay, there's not 1,800 anymore. We've made them all one. That business in a very good year would lose $2 billion. In a bad year, it would lose $5 billion. And it would do it continually, which is to say, if you look at the universe of junior mining companies, probably 80% of them will return ultimately to their intrinsic value, which is zero. 20% of the listings, however, generate so much wealth that they add credibility and sometimes luster to a sector that's an extraordinarily effective destroyer of capital. 10 years ago or so, I had an intern pull 25 TSXV junior listings at random and look at the income statements and balance sheets. And we discovered something shocking, which goes to your $3 million and how it went to money heaven. We found, and this isn't indicative necessarily across a broad market, it was only a 25 company sample, but we found that the median company spent over 60% of the capital that they raised on general and administrative expense, which meant that only about a third of the money went into the ground. When a major company decides to earn into a drilling program that is promoted by a consultant or a small company, traditionally they limit the general and administrative expenses to somewhere between 12 and 15%. But the industry average among the juniors has been that general and administrative expenses consume 65% of the capital employed. A very separate misnomer that people have, a narratively oriented misnomer, is that if the price, if the price of gold goes up, that it should have some impact on the share price of a company that doesn't have any gold, but is merely looking for gold. If you think about it rationally, if the price of gold goes from $1,000 to $1,800, but you don't have any gold, other than in terms of the narrative, it has no impact on the value of your company. Securities analysis, particularly in the junior sector, in the speculative sector, involves really three things: the data at hand, the geological data at hand, and the ability that you or your advisors have to understand that data. Large targets are good, small targets are bad. The second, and probably more important, is the unanswered question. When junior companies raise money, they raise money to increase the public's body of knowledge around their asset so that the valuation of that asset can be determined more authoritatively. For 30 years, I've been asking junior companies to tell me the most unimportant unanswered question concerning their deposits, what unanswered question they were trying to answer with the money that they were raised. And about 80% of them said that they had never considered the question in that context, which is to say that 80% of them have no earthly idea what they're doing. The third important characteristic has to do with the credibility of management. In other words, do I care what they think the most important unanswered question is, or how they propose to answer it? What you will find is that almost all of the value generated in intellectual capital businesses, whether they be biotechnology or mineral exploration, are a function of human resources. And almost all of the value is generated by a very small subset of management teams. So you need to find somebody who has been successful in the past, and you need their success to be immediately applicable to the task at hand. If someone tells you that, let's be politically correct, she was a success in mining because she operated a producing gold mine in 2-billion-year-old Archean rocks in French-speaking Quebec, but the value proposition today is that she is exploring rather than producing copper gold in 15-million-year-old accreted terrain in Spanish-speaking Peru. Yes, they're both mining, but the skill sets required are so radically different that the success that she enjoyed in Quebec is almost irrelevant to the task at hand. Do you understand that sort of progression? I mean, this is a very, very long discussion, and it's one that absolutely fascinates me. I've been talking about it for 40 years, but I don't think that either of us have time in the course of this interview to do it any justice at all.
Yeah, well, it's interesting just because our way of looking at balance sheets and income statements and cash flow statements and notes, you've just given us a metric to think about moving forward, which is simply and we've seen it a lot where companies raise, $5-6 million, and then the drill program they announce is like really, quite frankly, underwhelming. It's like they're going to do like 20 or 30 holes, and it's just like, oh. So
the answer there is in G&A.
Yeah.
The levels of general and administrative expense among Canadian juniors, even relative to their Australian peers, is shocking.
Yeah, and that's one of the things that So you're saying the metric is if you're looking at more of like, let's just say, a sort of mid-cap explorer, that you'd want that number to sit somewhere in the ballpark of 15 to 20%?
25%, because public company expenditures are higher. If you are public in Canada, it means that you flush $300,000 a year down the public company listing toilet. So you have to be operating at enough of a scale that you can pay the public company expense and have the public company expense amortized against your cost of capital. What it does mean is that a company that's spending, say, $1 million a year, if they're flushing $300,000 in attendant expenses as a consequence of being public, and then they're paying themselves living wages, and many of them pay themselves extravagant wages, what it means is that if they're raising and spending $1 million a year, probably $250,000 or $300,000 is going in the ground, which is, a very difficult way to actually make money for shareholders, other than telling stories on Bay Street and having the price go up.
Yeah. So when you look at mining deals, are you looking for at least some level of success in terms of drilling before you'll even consider investing, or
No, not at all. Not at all. I'm looking for people who have made me money before, who I know and love and trust, whose success has come not in capital markets, but rather in the ground. If Robert Friedland or Ross Beatty or someone of that ilk came to me and said, Rick, I have a really good idea in Kazakhstan. The probability is failure, but there is a possibility of success that could be worth $1 billion. What do you think? If they were somebody that I knew and loved and trusted and respected, and I was investing my money along with theirs, I wouldn't use client money for this, but I'd use my own money in a flash, absolutely in a flash. When you're using other people's money, speculative money, that's very different. In that circumstance, I would like to see a surface anomaly. I'd like to see it trenched to see that it's not a scab. I'd like to see some geophysics. And I'd love to see a drill hole. I'd love to see the third dimension. What you learn in exploration sometimes is that a stock that's moved from $1 to $3 because they hit a drill hole is substantially less expensive at $3 than it was at $1, because you have better information to do your valuation calculation from.
Do you think that there are any more massive discoveries out there? And secondly, do you think that there's enough money going into explorers for it to be found?
Most of the money that's been spent for the last 15 or 20 years has been wasted. There hasn't been enough spent, and it's been spent poorly. In Canada in particular, unfortunately, the value creation proposition has gone money to stocks and stocks to rocks rather than money to rocks, which means that too many drill holes have been spent twinning old drill holes on failed projects in the past to make a stock go from 15 cents to 45 cents. That's not the way you make discoveries. In other words, they've been drilling investors rather than drilling targets. Are there big discoveries yet to be made? You betcha. You betcha. Every day, the science gets better. Every day, these young explorationists that have access to technologies that I can't pronounce or spell are going around the world looking. What will change, of course, is that with the technologies that we employed in the past, which were mostly boot leather, the only deposits that we could discover were ones that we literally tripped over because these rocks were often resistive. In other words, they had to outcrop for us to find them. We will need to look undercover, and we will need to look in places that we are less comfortable with than we have been in the past. Most investors around the world are ethnocentric, so Americans want American discoveries and Canadians want Canadian discoveries. But our territory has been, fairly thoroughly walked and fairly thoroughly looked on. The big discoveries, the 10 million ounce discoveries in the future, are going to come in places that we're less comfortable with. They're going to come from Congo. They're going to come from Sudan. They're going to come from Kazakhstan. They're going to come from Russia. That's where the easy to discover deposits are going to come from. Will we make discoveries in Nevada? Sure, but they won't outcrop. They'll be under 200 meters of cover. And finding them will be hellishly tricky and hellishly expensive. Because there's a dearth of great projects around, and because as a society, we are living on resources that were discovered 30 years ago, which are increasingly rare. When these big discoveries are made, the major mining companies will pay eye-popping prices for them, truly eye-popping prices for them. And these discoveries will be few and far between, but having the patience and the tenacity and the courage to either, if you're an issuer, look for them, or if you're a speculator, speculate in them, is a very, very worthwhile endeavor.
How much do you think that that's hurt, like mining and investment? Our generation, I'm 37, I don't remember anybody discovering a gold property that was, something that just made a stock go from, like we've seen it in some cases, like a Great Bear Resources that started out quite small, but there wasn't a lot of noise on social media. But I'm talking the big discovery that makes people realize, wow, if you're early on something like this, this can be absolutely life-changing.
Well, if we go back 25 years, Murray Pezim with Hemlo, 80th drill hole took a 25-cent stock, 30 million ounce discovery. SK Creek, I remember. Pesum was also involved there. 30-cent stock went to $105.
Wow.
Detour Lake wasn't really a discovery so much as you looked at an old gold field and decided that you weren't going to look for veins anymore. You were going to look at the disseminated mineralization, but that was certainly, 50 cents to $20. Virginia Resources, the Eleanor deposit, 50 cents to 20-something dollars. A great example outside gold, a real grassroots discovery, was the Voisey's Bay nickel deposit. If my memory serves me well, that company was selling at $4 a share, and I think was finally taken out by Inco at $160 a share. And I'm just giving you the Canadian examples. There's a really attractive rash of discoveries taking place now. It's mostly taking place in Australia or by Australian listed companies. But we're seeing a fresh crop of discoveries unlike anything I've seen in probably 12 or 15 years. So I'm quite heartened by the value creation that's occurring around the world with the drill bit. I'm also, myself, not particularly or not as sensitive to perceived political risk as other people are. If you start, like I do, with the headline assumption that governments are always pernicious, the government that I'm the most afraid of is the one that's closest to me. So I've been, myself, very willing to invest and succeed in places like Serbia and Eritrea and Congo and Mali, and particularly Russia, which has been very good to me. But I understand that many people have a reticence about doing that.
Jay, you got anything?
I'm just really enjoying listening. I'm learning so much, and I think one of the things is people always say, look at the management team. But the description of how to look at the management team is really what so many people actually need the understanding on, right? Just because you're great at one job over here does not translate over here, right? So, I mean, my gears are still turning on that and all the different examples of everything I hear in the small cap world and going, okay, so that really wasn't that great. That's not as good as I thought it was, solely based on that, right?
Please understand that in the area that I think you operate in, which is small cap and micro cap, that the businesses that you're involved in, much more than you think, are intellectual capital rather than physical capital businesses. And the intellectual process is where value is added. If you are involved in speculating in intellectual processes, you better be speculating on good intellects. When I go back to when I was your age, I was extremely lucky in that I stumbled upon a group of very high achieving individuals, and I became indispensable for them because while they were going about employing capital intelligently, I was raising capital for them efficiently. When I think back on the 45 years that's elapsed, if all I had done is focused on the 10 or 12 best people that I met in my 20s and 30s, I didn't mess at all with anybody else. I didn't pay attention to the flotsam and jetsam of intellectual capital. If I just hung out with Adolph Lundin and Ross Beatty and Bob Quatermain, people like that, I would have worked half as hard and made twice as much money. Not an unattractive proposition. I'm not trying to say that I complain about what happened. I had a ball. I had a wonderfully good time. But in terms of making money, doing more business with fewer people would have served me substantially better. Not paying particular attention to anybody that wasn't on my greatest hits list.
Well, that's interesting advice and something that I don't know if that would have worked out for us early on based on how frothy things have been over the last year. And it's good. It's refreshing to hear that, because in this market, we've seen certain things that we kind of, threw money into as, sort of these are our, friends asking us to, and everybody else says, okay, we'll throw money in. It goes well. And we're kind of looking at each other going, really, this one? And then the stuff that we feel great about the people and great about what they're working on still, is kind of hasn't had that appreciation. So
understand in a goofy narrative-driven market that it's goofy narrative-driven stocks that work the best. That's why bull markets are so dangerous. People get infected by what your generation calls fear of missing out. Fear of missing out is one of the most stupid emotions in the history of mankind, but it's rife in bull markets, which is why bull markets are so dangerous. The reality of mining markets is that you make real predictable money as a contrarian. Buffett says by being brave when others are afraid and afraid when others are brave. It's easy to be brave when there's positive feedback mechanism, when everybody's brave. And in those circumstances, the butchers, the bakers, the candlestick makers, the morons, the people that have absolutely no common sense, that are the most aggressive, perform the best in the market. In Canadian parlance, when the market begins to resemble a hockey stick graph, it's fun, but what you need to remember is that the backside of that graph is just as steep as the front side of the graph, but a lot less fun if you happen to be long.
Well, Rick, thanks so much for taking the time to do this. I could tell normally Jay pipes in with about 50 questions, and I could tell he's been just taking it all away. He was doing that after, you did an interview with Cassandra for us. You were kind enough to do that a few weeks ago, and Jay called me up with a whole bunch of thoughts spinning from that one, which was the big takeaway from that one that I think both of us agreed on was we were investing in all these juniors and the majors hadn't moved. Which made us feel a little. So we probably should have just gone long the majors first, I suppose.
Well, those are the beginnings of good instincts.
Yeah. Well, we sincerely are grateful that you took an hour out of your Friday to come talk to us and our audience, and we.
In closing, if you'd allow me to, I'd like to make your audience an offer. I like speaking to all audiences, but I particularly enjoy speaking to young audiences. So many mentors have helped me that paying it forward is something that I really enjoy. Specifically, if any of your audience cares what I think about their natural resource portfolio, I'd like to tell them. If they'll go to a website, sprottusa.com/ranking, sprottusa.com/ranking, and enter their natural resource portfolio on that page. Please, by the way, no psychedelics, no pot stocks, no tech stocks, no stuff an old guy like me can't understand. I'll rank those portfolios 1 to 10, 1 being best, 10 being worst. And I will include, for those who ask for charts, the Barron's Gold Mining Index, which is a 50-year-old index, the broadest, longest running, and most inclusive gold equity index on the planet. And I'll also include a 100-year commodity chart, which shows in very graphic form how cheap commodities are relative to other asset classes going back 100 years. I'm delighted to do this. By the way, I'll comment occasionally on individual issues where I think that my comments might have value.
So I got the link there, right?
sprottusa.com/ranking. You got it. Thank you.
Okay, so that's awesome. And that's one of the things we try to tell our younger audience, and it's been hard for a lot of young people to get involved in finance because you're seeing sort of brokerages no longer be a thing, which is conventionally how young people would get on the street. And the one thing we always say is how we kind of found our way in this world. I'm a former math teacher, Jay's a former supervisor at HVAC job. Both of us just were passionate talking about small cap stocks online. Is reaching out to people, and like you've got a guy like Rule that's willing to communicate and give you his thoughts on his portfolio. That's a pretty generous offer for you to take the time to do that.
People did it for me, and I'm delighted to be of use.
Well, thank you so much. This was really fun and a great way to spend our Friday. I'm sure Jay and I will be on the phone all weekend with the gears going in our head trying to figure out half the things you said, which hopefully will make it so we can get our mining investments right next time and give us some
better track.
Yeah, a much better way to evaluate this macro environment, which is pretty much what I seem to spend most of my time thinking about right now.
Well, should you wish, in the future we can digress from the macro and do a micro around stock selection. I'm happy to do that. It might be too granular and too boring for your audience, but I suspect I've learned a few things over 45 years that might improve their performance.
Yeah, we'd love that. I think it was last Friday or last Wednesday. We actually went through a company's listing statement, a 200-page or maybe 500-page document, just sort of trying to break down the share structure and pro forma cash flow statements and all that sort of stuff. So our audience typically loves that kind of stuff.
Great, I do too.
Awesome. Well, thanks so much, Rick. This was
you.
really great, and we really appreciate your time.
Pleasure. Thank you.
So, Jay, I don't think we're going to get into Canadian microcap news today. Rick was kind enough to give us a full hour, so we took advantage of it. Quickly, do we have any videos coming up on the dive today?
Yes, we do. In about a half hour here, we have Tim Seymour on of Seymour Asset Management, and he's becoming a well-known cannabis name, actually, and as everyone knows, he's on CNBC. Aside from that, we've also got something coming out from Braden this afternoon on ARK Invest, which is it's a great article. It's not what you'd expect.
Taking a swing at the Queen?
It's not what you expect. I'm not going to wreck it for you. I'll let you read it yourself.
Yeah, it's never simple with Braden. You never know what you're going to get, but he's a talented writer. Any thoughts going into the weekend? Are you going to be like me and spend your whole weekend trying to figure out all this? I've probably called up 20 people, acting like an idiot, trying to comprehend everything that's going on here. Last night, our staff, who actually really understands this stuff that we got to have on is young Justin. He's a great resource. He's got a pretty good grasp on this.
Right, and he gets after it. Absolutely. We've talked to him a few times. We were sitting down with Hermina, our macro writer.
He was walking Hermina and I through all this SLR stuff last night. Like, we've got a whole PowerPoint document of notes the three of us were put together. He's got a really strong grasp on all this macro stuff.
Yeah, it's great. But I mean, this weekend, I've got tons of content I got to get through. It's been a busy week despite what's happening in the markets itself. Most people won't believe this, but I spend so much time writing and editing and everything else that I don't actually get the chance to really pay attention to markets as a whole. Most days, it's after the show that I first actually look at the markets to see what's going on. So my week's been packed. I've got tons of stuff coming out this weekend. There's more than a few videos that I want out. There's more than a few articles from Jim McFadden I got to get to. I'm backed up on stuff from young Justin, Hermina, everything. It's going to be a very busy, content-filled weekend.
I was thinking of sitting down and doing a video on iguana technologies, just like a video essay of why I like the investment thesis. That's the one thing that I was planning on working on this weekend. Just, you fall in love with the stock. You fall in love with the stock. You know what you know, right?
We've all been there. But, yeah, we're running late here, so you want to give the disclaimer?
Okay, I'll give the disclaimer. So nothing we talk about on here is a buy or a sell recommendation. Everything's just for informational, entertainment purposes only. If you're looking for that sort of thing, go see a licensed financial advisor. Heck, even reach out to Rick Rule and have him rate your portfolio. Again, go to sprottusa.com/ranking. Look, this is like, things really started happening for me in my life when I just started reaching out to people and talking to people. You'd be surprised how helpful, powerful, and smart people are if you just show them that you care and you're engaged and you're going to bring value in a discussion. So you got a guy like Rick Rule who's saying, I'll engage with my audience. I'll communicate with you guys. Don't be afraid to reach out to them. You guys could have spent your last hour staring at any screen, any place in the world. But you know where you guys chose to spend it with? Do you know where they chose to spend it with, Jay?
Right here with us.
With us. And you know what, guys? I appreciate that. Each and every one of you, from the bashers to the trolls, all of you. And I hope you all have a great weekend. Sincerely, from myself, my sidekick, Jay, and the rest of the staff here at The Dive. See you guys Monday.